home buying feels overwhelming, intimidating, and for lack of a better term, opaque.
Hello, and welcome to another episode of Housing Insiders, the podcast for founders, builders, lenders, regulators, and all of us who believe everyone should be well housed. Normally, you'd hear Jonathan Lawless say that. Today, I'm Jeremy Potter, and I'm introducing a special episode of Housing Insiders. At the beginning of each episode, you hear me say that we host conversations you won't hear anywhere else about how to make housing more innovative and attainable. Today, there's one special caveat to this episode. This is a conversation that took place at the Prosperity Summit in October 2025. So we recorded a panel. The panel's focus was the death of the starter home. Now what? Niles Lichtenstein, the CEO and founder of Nestment, and I had a conversation that you're about to hear about what should first-time homebuyers be thinking, what should first-time homebuyers be doing, and ultimately, until we start building more starter homes, what can first-time homebuyers do to start down the path of homeownership? Nestment is a first-time homebuyer platform, everything from education, tools and solutions, financing, and really understanding how to become ready and how to find the right fit for your first home. You'll hear from Niles a little bit more about Nestment in the episode, as well as what some of the solutions are that we see for first-time homebuyers in the market today, and maybe a little bit about where the market's going. So thank you for listening to this special episode of Housing Insiders, and enjoy the conversation with Niles and I.
That sounds
Thank
really
you.
like
Thank you, everybody, for coming. This is the death of the starter home. Now what? You may not have realized that you were going to come to a memorial service. So I'll start with this, and then we'll introduce ourselves. The starter home, 1934 to 2024. The family of the starter home announced their passing at 90 years old of completely predictable and foreseeable causes. The starter home is survived by luxury condos, second and vacation homes, single-family rentals, and cash-only offers on 4,000 square foot McMansions. The starter home was born in 1934 when Congress created the Federal Housing Administration, FHA. For the next 20 years, FHA helped military veterans, low-income, and handicapped Americans find their first home. The starter home was a 2 to 3 bedroom, 1 to 1.5 bath home, a few styles, craftsman, ranch, kit, enough for a couple of decent rooms and a bath, as quoted by George Bailey in Frank Capra's It's a Wonderful Life. In fact, the ideal was a reality for many Americans. The starter home helped millions of people move from rental apartments to homeownership, enabling family formation and economic mobility and community stability. Families in starter homes are known to buy pizza on Fridays and pet food for numerous pets, house paint and wallpaper for the local hardware store, soft serve ice cream on summer evenings, and copious amounts of Halloween, Valentine's Day, Christmas, and Easter candy. The starter home is responsible for social and economic outcomes. Where you live is a data-driven predictor of opportunity. Starter home was a key indicator for prosperity, for better or worse, in communities across the country. One of starter home's early contributions was addressing housing instability. After World War II, returning veterans were offered federal legislation to identify and obtain starter home. Even then, with wide federal support, many veterans, particularly Black and Indigenous veterans, were systematically blocked from finding starter home. These veterans needed to actually redefine starter home and what starter home meant to them. And that was one of the first times that starter home evolved. Later, starter home became a point of social pride, growing larger and newer. Builders built starter home all across Sunbelt and the South. For a time, starter home was the first mile marker on the road to success and generational wealth. Home equity increases, beginning with starter home, have propelled generations of Americans to comfortable lives in retirement. Starter home remained even as owners moved out and moved up to larger homes in the suburbs, and soon new highways and infrastructure investments followed those homeowners to their new communities, leaving starter home behind. New first-time homebuyers stepped up and stepped in to starter home. However, instead of propelling generational wealth, new starter home cost more and was not as new anymore as it used to be. increased property values meant increased taxes. Maintenance costs only mounted as starter home aged. Generations of Americans came of home buying age, but the homes remained the same. The starter home served first-time homebuyers and eventually renters looking to become homeowners someday until 2023, when starter home was diagnosed with terminal economic conditions. The starter home will be remembered in a not-so-brief lip service by older relatives at any time homeownership comes up around the holidays or at dinner. The starter home leaves behind the American dream, already passed in 2023, and two offspring, factory-built housing and shared equity ownership models. The next generation will be homeownership in which renters will earn equity on a way to own a portion of the community, a portion of the home, or shares in their co-op or HOA. In lieu of flowers, the starter home wishes for donations to be made in philosophies opposing NIMBYism. Starter home was 90 years old. So I start with that simply to say what we all know in the room. My name is Jeremy Potter. I'm a consultant with Next Belt Strategies, which is just me. And I've been working in housing finance, housing innovation, and housing policy. I had spent time at independent mortgage companies. I worked at Rocket Mortgage for 6 years, where I led strategy and innovation. And for the last few years, I've been working with startup companies, growth companies, and established companies on new ways to achieve some sort of housing solution. That could be supply side, which we can talk about, and it obviously can be finance side to make it more available, more attainable. My co-host for today is Niles Lichtenstein.
Oh, yeah, this is a podcast, right?
Yeah, true. We are recording this.
We are recording this.
But we wanted to bring Niles back. You probably just saw him on the main stage during the plenary session, so that we can kind of break down in detail a lot of the different opportunities and models that were talked about. We have what Nestment has seen in their data, which we'll talk about, and also some other ideas about how to address getting into the market and getting into the market earlier and starting to earn equity ownership earlier. So Niles, maybe since we did just hear from you, but maybe you can talk a little bit more about where Nestment is in the process as a company. You talked a lot about the philosophy, you talked a lot about the stories. As we talk today about the starter home and what comes next, I want to give you a chance first to just tell the folks, you built Nestment. Where are you in that process, and who are you serving predominantly today? And then we'll jump in.
Yeah, so thanks everybody for being here. And then if any of this is redundant to the plenary, let me know. But yeah, so Nestment, we started off with the notion of co-buying, and we did that for a number of reasons. It actually see some friends in the crowd. So we started with the market wedge of co-buying because, not many people knew that you could have up to 4 co-owners on a conventional mortgage. Just even sometimes loan officers didn't even know that as well. And so we started to see family and friends saying, hey, this is too hard to figure out on our own. How do we come together? So we took something that was, pretty complex, right? In the sense of not just the operational side, but also the understanding. What's the operating agreement going to be? How is it financed? All of those different things. How do I look at a listing and break things apart? That type of thing. So we started with this market wedge of co-ownership and co-buying. And then we kind of moved into also house hacking. And so this was very much consumer-led, like people saying, hey, this is what we're looking at because we are trying to own, right? Like we know that, home ownership, first-time home ownership rates have gone below 30%, up as low as 24%, which is the lowest market's ever been in terms of first-time home ownerships as a part of transactions, right, each year, with the median age of 38, right? But the aspiration for home ownership, if you ask people, it's actually as high as ever, with the exception of feeling like I can't get there, right? So if you ask them, do you want to own a home? 86% of renters will say yes, but do you think you can get there? And then that drops precipitously, right? And so we saw that. So then we also started to look at house hacking, which was being able to live in one unit while renting out the other. There were some incredible programs. The Fannie program had just come out in November, I think, 2023 of You put 5% down, and someone might say, well, now my mortgage is too high, but then you've got the rental income coming in, so it helps subsidize. So actually, you needed to figure that out. So we added house hacking in. If you heard me talk about it, I think it's a huge opportunity. 9 million 2 to 4 unit buildings, only 1 million are owner occupied. Also, no one's building 2 to 4 unit buildings anymore. So a lot of the owners are actually aging out too, and a lot of the family members want to sell. So I've been hugely supportive of folks. Sometimes the first thing when people come to me, I say, what's the place you're living in? Can we buy that one, for you? You've already established a rental relationship with this landlord or something like that. The last part I would say is, so we started with house hacking and co-buying, and we started this home buying accelerator called NestGen that's open for people to come and get educated. And we joked that 100% of the people came for house hacking or co-buying, but over 50% of the people actually left being able to buy some form of home, right? And whether it 50, and that's a huge rate comparatively to like people coming in. And some of it was just about certain programs and knowledge and knowing how. Some of it was a shared equity program to help get into that home, that single family home, because they didn't want to be in a 2 to 4 unit. So what we've essentially created is this layer. We call it a home buying coach. We've been playing on. One customer said, you were kind of like my wedding planner, but instead of my big day, it was a big purchase. So at first we were like, okay, maybe we're like the wedding planner for home buying. Ultimately, there's also this accountability aspect to it, and we started to help athletes as well, not the like big stars, but the ones who were making a little bit less that couldn't even afford their own places, right? And so now we're this home buying coach, right? So we help put these opportunities together, align and match. We understand where you are. We take you as you are, right? Don't feel judgment from us. This is about you coming, us being the consumer advocate, creating the pathway, and making sure you've got the right resources, tools, and ultimately right financing and agent. And we could talk about what we do beyond that, but we want to help you be a successful homeowner.
So let's take NestGen, which is really going to be a shorthand for us talking about first-time homebuyers and talking about this trust aspect. And we'll go through each of these. We'll go through co-buying, we'll go through house hacking, rent vesting, shared equity, and we'll talk about each of those. But I want to start kind of first with this expectation, the expectation of the customer, the expectation of the industry, because, when I say starter home is dead, we're also actually talking about an inability for real estate and mortgage to stick with a customer long enough to get them these options, to get them that trust, to get them this belief. It's just natural because the economics of time, how they're compensated, and lead gen means I don't have the ability to work with a large group of people over years. I work with people in a 90 to 90 and 120 day window when they're in market transacting. And so I would say one reason NestGen exists, but also why we need to work on this area, is that there just isn't really yet a strong economic model to work with first-time home buyers over a long period of time and have it fit into big-scaled digital solutions or big-scaled tools. And so NestGen actually has the opportunity to partner with real estate agents and mortgage companies to essentially will nurture for you. I say will, but just as those of us who believe that this is important, is a big piece of this. And so when you say trust, I think there's also, it isn't even trust, it's actually just an awareness on behalf of mortgage professionals and real estate agents that these types of programs exist. Because if I don't have to work with somebody more than 90 or 120 days, I don't need to know about them. Typically, I only have to work with the people who are transacting in real time. And so I don't think it's that surprising that these programs don't have more visibility, but co-buying in particular, having already been approved by all these mortgage programs, makes it the ideal place to start. That said, everybody, including mortgage professionals who I talk to, say, well, nobody will ever do that. Nobody will ever do that because it's too hard. What if somebody gets married? What if somebody gets another job? What if somebody leaves? So can you talk a little bit about the actual tactical way that borrowers, customers, work together with Nestment or just on their own, either way, to make a co-buying mortgage happen separate from the application, the actual living part?
Yeah. So first, I think when we think about co-buying, there's actually a lot of unique, let's call it a lot of unique arrangements, right? And why I say this is because there is the co-buying aspect of we are going to co-buy together and we're going to live there together, right? So we have two friends who co-buy the place in DC actually, right? And said, we're going to get a 2-bedroom because what we're paying for rent right now could actually pay the mortgage, right? And which is interesting. And we'll talk about how because we essentially put in an operating agreement and all of those things that make them feel a lot better and have some kind of rules and guidelines around it too. They're typically getting a conventional mortgage and taking it out. If we go over 4 people, there's ways where it's placed in an LLC without due sale and clause and some other things. But I think there's that scenario. There's the scenario where we all live in one unit, right? And maybe there's also other units that rent. And that rental, like in the case of Weldon and John, where they lived in 2 units but rented out 2 units, right? And so they were able to get that income and leverage that income. There's actually a really interesting one, which is we found that a ton of people actually have a relative or a friend who wants to invest in real estate. And if you as a co-buyer actually come with some really, really good advantages. One, like let's say you have that relative that wants to invest, you can go in now, you're going to get a primary rate, right? A primary home buying rate. You might also have the opportunity to leverage some first-time home buying programs, right? And then you also have the ability to if you're getting a 2 to 4 unit, add these investment portions to it. So part of your shared equity could actually be your uncle or a family member or friend who might be set. And I think it's an interesting place, this notion of found money, where it's like, you're not giving me a gift. This is not about a gift, right? This is actually about you wanting to put capital to work, but have a purpose and mission. And I think people don't realize how big of an opportunity even that is, right?
Yeah, I'm imagining, so the Venn diagram of overlapping circles here is that co-buying a primary residence with other people who are actually in the house with you is one circle. It overlaps somewhat with buying that 2 to 4 unit property and then living in one and then renting the others out, whether you buy 2 together or one or one person doing that. And then that has an overlapping circle with shared equity, which is just an investor being the rich uncle, the investor being the rich parents. We know 65% of first-time home buyers get money from somebody in their family to make a down payment. So this is basically an option for investors to come in separate from family to get that done. So those all kind of overlap. So sticking in the co-buying of the primary residence together for a second, you mentioned the operating agreement. We should also talk about some of the downsides.
Definitely.
Fannie and Freddie have not fixed the 100%, how should I call it, 100% liability for the whole property in the application. So even though I'm going in with 3 or 4 separate people and I'm only responsible for a quarter of the monthly payment and a quarter of the expenses per the agreement, I'm on the hook from a credit perspective and a foreclosure perspective for 100% of the property.
Totally.
So that is one thing that we could probably talk about at some point addressing, but for now, that is one of the things that you have to accept as a co-buyer. Is there anything else that I'm not thinking of in that arrangement that you would say, in that circle in particular, we should know about, pros or cons?
I think that's the biggest one right there, is just the liability now is on the group, right? So like a lot of the things we have in the agreement is, how does someone, if they do decide that they want to sell their portion, right? What do they go through? And it's kind of a time-based step process. First, the other owner gets first right of refusal. That then goes to opening it up to family and friends if they want to be able to be a co-investor. And then that goes to, but then you've got to deal with, okay, well, if we're changing things out, do we have to refinance and things of that nature, which if you bought recently, it's less of an issue than if you bought when it was like 2-3%, right? 2.5%. So that's coming up a little bit less. And then if you can't get to that place, we've obviously talked about, could you have a marketplace where somebody purchases that as well? But if you can't get to that place, then it is a hangsman clause on like, hey, we're going to sell it at this point, right? So what we've found so far, right, and people who have bought now, it's only a few years right in, but like that but there have been a couple sales. They've, so far it's been, the issues haven't been around the sales and the money. It's more been around like, what expenses do we have to deal with? Like, I want to go and I want to develop the backyard, right? And you don't, right? Those are the types of things that I think, happen in those relationships. But I actually, what's been really interesting and fun is to watch as people have actually gotten their second place where they've now been like, okay, now we can rent out both of our bedrooms or our units, and we can get to that, and now we've got a rental property, which ultimately, is helping them as well.
Yeah, I want to say that back so that I understand it, because I think that's a really good point. So I've been saying, and I don't know that this actually holds up under a ton of scrutiny, but you tell me, but I've been saying that home equity is like compound interest. You have to get in early and you have to let it grow. And so what we've been doing for a really long time is telling people to work harder and wait longer, instead of finding ways to just get in with something. So what you're saying is a first-time homebuyer co-buys a property, gets enough equity or career or income advancement to then be able to go buy their own house, let's say, without co-buyers, maybe, and then keep that property and continue to rent it out at, getting 25%, 33%, whatever portion is theirs, and that ends up offsetting probably some of the cost of their monthly payment. I
have a real life scenario right now. I have a tenant in one of my places. I'm, of course, a house hacker and co-buyer. But in college, he and his friend decided to go in and buy a place in their last year in San Diego. And they rented out the other rooms. Now they're renting. They had saved up the first 3 years because that was their intent. And that property that he makes off pays his rent at my place. And now he's actually leaving to go actually get a 2-unit with some other folks. But, there's definitely a pathway there that allows for, like you said, us thinking about how can you get to equity as quick as possible, right? Because I think what gets very scary is, in the current data, if you think that 20% is what you always have to come up with for that, plus now the new monthly net, that is almost 80% of your average millennial's salary, but almost 30 to 35% is going towards rent. So the math doesn't math right there, right? And so you have to find a way to get out of that. You have to find, or else you end up where we're at right now, which is 38 being the average or the median age. There's a lot older, and it gets me really concerned, because then historically, right, you then have this gap that keeps on getting bigger between owners and renters. So
yeah, I was just looking for a statistic because our friends at First Home IQ did the next gen homebuyer report. So next gen, we're all working together on this. But actually, 40% of millennials and Gen Z don't believe homeownership is attainable, and 60% currently don't think it's a good idea to buy right now. So that loss of trust is pretty significant. Then you start layering what you were talking about, which is I actually don't know what a down payment, I don't know what options I have for a down payment. I have a lot of confusion. So something like 45% of millennials and Gen Z still think 20% down is the down payment. So those types of things kind of are the confluence here. Co-buying at least starts breaking some of them down, right? I want to kind of then move to what you just said, which is we have this loss of trust. We have people waiting longer and buying later in life if and when they do. That first-time home buyer is now being asked to take on, so in the co-buying situation that we just talked about, take on a little bit more complexity, but they get something.
Yep.
In the house hacking version, what we're calling the house hacking version, to move to that circle on the Venn diagram, is buying a multi-unit property and essentially becoming a landlord for your first home buyer. When we see the number going up, it tells me that potentially that's a more experienced person who can accept the responsibility. Can you talk a little bit about what you're seeing in the data and what you're seeing in stories with Nestment about how hard it is, or should we think of it as an obstacle to be a landlord that is also in their first home at the same time?
Yeah, no, I think that's a great point, and it does, tend to sometimes have people deviate from that path, right? Or say that that's not for me. But what I've noticed is that more and more people, one, I mean, we've also shown where property management, when you actually look at how much it costs, it'll be 6 to 10% of the rental rates. And so, one of the things we factor into all of our calculators that will pull a Zillow or Redfin listing in and I'll look at is adding that in and saying, one of the benefits is then you get your own super, so you actually have that person working on your property. So there are ways to do that. I think the finances are so compelling on these ones, though. Mm-hmm. You've essentially rebased the calculation, right? And what I mean by that is your 2 to 4 unit is probably around 20 to 30% less per square foot than your single family home, right? But your renters are not saying to themselves like, oh, I'm in a 3 unit, therefore I'm going to pay less rent. They actually pay market for that 2-bedroom or 3-bedroom. So you've actually kind of created this little arbitrage opportunity where you're getting market rent for less per square foot, right? And then you're using it. I mean, I live in a triplex. It's in the middle of San Francisco, which is not a cheap place. But I'm able to have a family of 4 at the top of the triplex, and then we rent out the other 2 units, and it pays all the mortgage and property tax and things of that nature, right? So, it becomes a pretty compelling financial, play for folks. And then I think it's just if people want to go there. The other thing is you only technically have to live there for a year. So at some point you could, move out. But I find a lot of people end up living there for longer than that.
Yeah, I think so too. I think the thing I mentioned earlier about, having what I would call like the establishment industry, selling what it knows, it actually can be hard to sell that story. But when you sit down and look at it, I'm even thinking of the VA loan program where you could do exactly what you said with 0 down.
Totally.
It does become pretty compelling. So you've seen that almost 40% of your successful users have done the primary multifamily option. And I think not just in high cost areas, Niles is talking about San Francisco. I live in Detroit. It's also a fantastic option in Detroit. And I think with the way that rents are in most cities, we see people in Detroit paying over market rent just in order to have a safe place that they trust. And so they could easily be owning for a lot less, and to Niles' point, for free, if the duplex or the triplex were an option and available to them. So I think getting really the industry aware of your calculators and some of what the math looks like, whether you're in a high cost city or a developing city like Detroit.
I honestly think that one is probably the new starter home. If I was to say what is one that is like you have a lot of people there's creating some let's call it momentum around. Obviously people call it house hacking, which can have interesting terms to it, right? But I think you've definitely got a lot of people. I ask, millennial and Gen Z folks, and usually there's one friend within the group who's done it, right at this point. And they had to go through a lot to do it, so we make it a lot easier for that. But then we also let the other folks too.
So if about 40 to 50% of people are going to want a single family home, maybe 40-ish% are going to house hack. There's another category I want to bring up here, which is before we get to shared equity, which is kind of a third version. I didn't mention it quite on the same level with these other two, but you call it rent vesting. This is the idea that I'm going to rent my primary residence and invest in a rental property elsewhere. So I'm in Brooklyn, I'm renting, I'll buy a rental property in upstate New York or Pennsylvania or New Jersey or something, and I'll get equity that way. So again, getting in early, getting in somehow, and trying to get home equity. What are you seeing from that cohort? That was a bigger number than I anticipated, by the way, in your data, which was a 19% of people used rent vesting as an option, renting in a high cost area and then buying a property elsewhere. What have you learned from that group, and what is the sort of pros and cons of rent vesting?
Yeah, no, it's an interesting one because I mean we definitely have over-indexed for some of the like high cost areas, right? Where it's just going to take you forever, and so what we have is a lot of people who say to themselves, they look at the math and they're like, I don't know when I'm going to be able to afford in this place. And so how can I kind of get into the game? I think actually Airbnb made it, a much more acceptable in a way, because all of a sudden you could imagine yourself having that maybe vacation rental first, right? And you're like, okay, and that's still, and you can't tell me you don't feel like a homeowner. People are so proud when they buy that home, right? And they love what they get. And now they're renting it out part of the time. Maybe they're going up there part of the time. They're gaining equity from it as well. And so, I gave that story of Selena. And Selena and Wade were two friends in Brooklyn. And they were like, I'm never going to be able to afford Brooklyn, but I love being in Brooklyn for my job and other things. So they started with Hudson Valley. They bought that. And then actually Selena's gone on to get a duplex now in Kingston and have it as a primary. But but rent vesting is my co-founder did that, right? So like every person 50% of our new hires actually have been Nestment customers, which is pretty phenomenal. And we try to like make sure that we're also hiring from different areas. So Kim, who just joined the team, was part of the LA Unified School District, but she's house hacked twice now, right? And so that was how she was able to afford LA. So it's just interesting because you see people wanting to spread this knowledge and think about that. But my co-founder grew up in San Diego, lives in San Francisco, was like, I'm never going to be able to own. His two buddies in San Diego that he grew up with were like, one guy's living in the ADU behind his parents' house with his kid, right? Like that's kind of the scenario, and that's very real. And so they were like, well, we love playing golf. They looked up the 100 public golf courses, and they called their group pin seekers, so that they were seeking pins, but they were able to all put, $10K down each and get a place on the golf course that they now go visit, twice a year as part of their trip, and they rent it out, and they've already gained a decent amount of equity from it. And so, so you have these moments that are really meaningful. We also sometimes call them the shift audience. Second home is the first time buying. Rent vesting is another way. If you are an immigrant worker in Menlo Park because you're an engineer there, and we see this a lot, there's no way you're affording Menlo Park or Palo Alto. Even a 2 to 4 unit in like Menlo Park or Palo Alto, where there's a ton of tech work going on, you're talking about millions, right? Even to get that. So what can you start with there besides having to commute, 3 hours to work?
Built Rewards is a payment platform for housing that rewards members in their home and neighborhood. Built is the payment platform for over 5 million units because Built provides incredible value to residents and to property owners and managers that use it. Properties using Built have seen reduced turnover, increased usage of electronic payments, and fewer missed payments. And with our latest resident loyalty program, Built is changing the way that property managers can reward good behavior. Managers can assign rewards and benefits to tenants for a variety of activities like early lease renewal. If you're interested in learning more, go to alliance.builtrewards.com.
The idea around all of this, because we're going to shift now into shared equity, the idea around all of this is get in early, get in some way, fractional or partial ownership, and start earning and see where you can go from there. So that kind of brings us to shared equity. And one of the things that I have been thinking a lot about is why we are stuck in the sort of binary mode that I get pre-qualified for an amount of financing, and then that's the home I have to go look for. My pre-qualification, pre-approval, that's the listing that I go shopping for. And what I think the new starter home is your borrowing power. That is actually your starter home. So if I have $300,000, let's say, of a pre-approved credit amount, that's the amount that I need to have a 30-year horizon to earn effectively, because then we're just selling against a 30-year fixed mortgage, really. And so if that's in a $450,000 house, does first-time home buyer care Probably not, because they're earning the amount they're eligible to earn. So the system doesn't take on additional risk, really, because that's what we know that this person is capable of repaying. They have the expectation that that's what they're going to earn over 30 years, paying off principal and interest payments. And so with shared equity, that becomes a reality a lot faster. We've been talking about these structures that are, house focused. Now we're going to shift and talk a little bit about just financing focused. And it requires, for sure, a secondary market, a market of investors who are willing to take that risk over 10, 20, and 30 years for home price appreciation. We've seen a lot of shared equity platforms come in initially to buy equity from existing homeowners and then package it up to investors along a certain number of terms and conditions. The most common is some multiple, right? That was the first thing we saw to get sort of the capital markets comfortable with it was, we'll come in, we'll buy a percentage of your house, 10%, 20% of your outstanding equity, and then you owe us 2 times that or 3 times that back at the end of this term, or if you end the term earlier, something like that. What we're starting to see now is a true one-for-one silent investor. It's not commonplace yet, but a lot of companies, including Homium, who you just saw in the main session, are finding that there is capital that can sit next to a homeowner patiently and relatively quietly for 10 years on home price appreciation. And the reason is bonds and RMBS, what they're typically used to buying, mortgage-backed securities, return a 4% coupon. And so if I'm competing with 4 or 5%, home price appreciation, especially mixed across a lot of different geographies, can actually return that. So we're, asking corporate balance sheets and we're asking impact investors and other investors to look at it as another option for that kind of 5% range, but you're on the equity side of the balance sheet instead of the debt side. So that's a really important market feature that has to happen because of the trust factor that we're talking about. In order for people to trust that they're not going to be kicked out, the first question I used to get at Rocket when we would pilot or think about some of these ideas, the very first question I would get, even from industry professionals, was like, which room do you own? Which room do they own? What portion of my house? Thinking of it literally. And so getting everyone comfortable with the fact that there are investors out there that want this. This is a diversification play for homeowners as well as investors. I like to joke, all my eggs are in one basket, a 30-year fixed loan on a corner of a street in Detroit, Michigan. I'm all in. If I could sell half of that house and buy equity in a portfolio of houses all across the country, I would never leave Detroit. I love it. I love my corner. But I wouldn't mind having some diversification where I get that benefit. That's for an existing homeowner in a more kind of sophisticated mindset. But for a first-time home buyer, if you were to tell them you can own today at your pre-approval limit, whatever that is, $150,000, $200,000, $250,000, or you can wait and see, and you may never own, but you'll have 100% of the house if you do someday. I don't think anyone thinks about it anymore as a big deal to say, just get me in. I'll take that. I'll take that upside, and I'll take that opportunity as long as there's a trusted market next to it. So as you think about the next evolution of Nestment, you think the next evolution of first-time homebuyers getting access to things, where does share equity fit in your thinking, and what is your reaction to kind of what I just laid out?
You did a great job of laying it out. I know sometimes people call it like the rich uncle or something, but they do that jokingly, but they also do that because it at least kind of familiarizes it for somebody in a way, because, the thing that we've seen, and we're actually fans of a lot of shared equity, we're starting to become the kind of consumer advocate, right? Mm-hmm. So people look to us to say, is this the right way to go? Because one of the most interesting things is just that credibility and that trust and so forth. Like, people rather put 5% down and try to make it up oftentimes and say, well, I'm going to go and get the other 10% from this shared equity because I'm not sure what the catch is. So what we've been trying to do is do a lot more education, a lot more trust building, a lot more explanation, frankly, of how this can be helpful to you and seeing it as a benefit, right? So as we're thinking about Nestment, we're thinking about how can we start to say, and this is a great and tough place to be in for us, right? Because we mess up somewhere, right? And we will get heat for that, right? On some level. But I think there has to be somebody who says, I'm not the lender, I'm not the financer, I'm not the end agent or brokerage at the end of the, but what I am is the system that's understanding you and saying, here are your options, here are the pluses and minuses, and is empowering you to then make a decision. Right? In saying, hey, you could decide not to, but here's what that decision looks like. Because ultimately, then, if you make that decision and you choose and you say, no, I'm going to take Rich Uncle Homium or crib equity and we're going to make this work, then, and then you'll start to get more use cases, obviously, and then that will kind of spread over time. But again, because this is so ingrained in that American dream concept, even the starter home, the single family home, that we have to kind of build that. So I would say, confidence, trust, and insight, and then ultimately, I think our role at Nestment is to then empower that consumer to feel like, okay, I can actively think about these decisions, right? Like the interesting thing that I get asked a lot about is like, isn't this super manual when you're working with buyers? Like, do they take up, because we give everyone a dedicated, home buying coach. We used to call it planners, but home buying coach. No, and we go, it's actually not, because what ends up happening is we spend a good amount of time right up front to understand, right? And then we definitely have a ton of tools on the back end to make things easier. And then we kind of empower people and educate people. They can join our education platform and stuff to say, I feel like I can make this decision, right? And then they've got their lender or finance partner, and then they've got their agent there, right? And so what we end up being is this person, but they do give us a call when like they're about to put in the offer. They do give us a call. We are their cheerleader, their support, like things like that. And so we're there to kind of support that process. So
yeah, I think that's a really key point. We're actually seeing it in a lot of different ways, right? The thought that I just had was embedded fintech, where we moved all these payment tools and we moved all of these other types of solutions to the point of need, to the point of transaction, to the moment when somebody's thinking about it. We haven't really done that, honestly, with housing finance or mortgage. And what you're saying is you can kind of pull these tools forward, give them to somebody at that moment where you're almost being proactive and embedding it in their
completely
life.
And we actually have incentivized, we've gamified the pathway. So if you look at the newest tools too, what's crazy is just the money that's there that we can actually give back to consumers too in the process when you make this more efficient. So one of the things a consumer goes down, I'm a big Lord of the Rings nerd, so I always see our buyers as like Frodo and we're Gandalf, right? And they're gonna meet the elf and dwarf on the way and we're gonna get to Mordor, but you actually have this path that you're going down, right? And you're meeting the different characters along the way. And as you're completing steps, you're actually getting money into a down payment wallet on the right. Mm-hmm. So literally we're saying like, okay, you complete this step. And it's not about the $250 that you get from going through the process of pre-approval or deciding on which kind of financing thing. It's not about that. That's not going to make the end difference. But what it does do is it triggers, hey, I'm going to go down this path, right? I'm going to make this happen. And I get something for it, right? There's this incentive that I get paid back for that thing. And so a lot of this is around psychology and user experience too. And a lot of it is around, also just laying things out. Because the things that we heard from folks were home buying feels overwhelming, intimidating, and for lack of a better term, opaque, right? There's not that level of transparency. So when I think about, working with Clear Capital and getting the offer estimator tool, right? It's not going to change them working with an agent who's going to help them strategize on the offer, but they're going to feel a lot better when the agent says, oh, this is the offer we think you should go with, and they have the desktop AVM, and the offer estimator. So why are we not, this is the biggest purchase people will make. Why are we not empowering them? Why are we not making this a delightful journey? Everyone who gets pre-approved or goes through a finance gets a bottle of bubbles from my favorite Sonoma winery from me, or chocolate if they don't drink, right? And it comes with a note that says, you haven't transacted yet, but this is a big moment. You've shared, this financial information, you should celebrate this moment, right? Because it is meaningful, right? So we're trying to think about what's the right housewarming gift. I'm thinking UGG slippers.
Oh yeah,
right? Yeah. I think that might be a good one.
I worked for a mortgage company in New England for the first job I had in this industry, and there was a company that would deliver warm cookies to the closings, and we partnered with them for a while, so I can understand that. One of the things that you mentioned, though, is like we all talk all the time about wanting educated, financially literate, and confident consumers. I mean, we're all working at that in all of our organizations, and most companies, real estate brokerages, real estate agents, mortgage companies, they tell you that. But to your point, the numbers don't bear that out, that we feel that way. Zillow just did a study about 18 months ago that 52% of first-time homebuyers still cry, literally cry, at some point in the process. So we have all these digital tools, and we are far from confident like consumers. One of the things that Niles just mentioned that I experienced recently was I'm very insecure about cars. I have absolutely no idea how an engine works. And ChatGPT is like the best thing that happened to me, because I can now put things in it and ask it what it means, and it has like a pretty decent feedback on like, so when I go into the mechanic now, I don't feel as insecure anymore about being like, here you go. I don't know what this new, making noises with my mouth. Like, I don't know what's going on. And I feel I honestly feel like that's how first-time home buyers have felt for a really long time, because we don't nurture, we don't have the economics to walk with them. So I want to talk a little bit about the economics. It's expensive to build technology. It's expensive, as we all know, to give people tools and solutions over a long period of time. So I guess I'll put the question to you this way. Are you seeing new partners and new ways to partner that actually give you the ability to build, innovate, and still give the bubbles, still give the gamification credits and the rewards? Like, what else does the industry need to do, or what could organizations be doing? Like, let's talk about the economic model for a second, figure out how to expand this.
Yeah, totally. So, I mean, as some folks who I know from Rocket are here, we know how much it costs to originate a loan, right? Like, what was it, 12 to 14,000 or something like that?
That was the last MBA study, I think, was $13,000.
Right, and a big portion of that's marketing and sales.
People in marketing,
and things like that. So I think you can actually lower that by being in trusted places for folks and deliver like very efficiently on that. You can start to give money back to consumers, right? And make that kind of meaningful too. And you can start to pay for the education, right? So there's that element of it. There's obviously what we've went from was we do a rev share with the agent. And, no one knew us 2 years ago. And so they were like, no, we won't do it. So we just gave them folks for free. It was 0 and 100. Now it's 50-50 with all the major brokerages, because we literally have shown that we're bringing you net new folks. In fact, they're asking us to come and nurture people for them, right? The other way is that we're making it an employer benefit, right? So one of the newest things that we're bringing is saying, hey, you organization, you employer, you association, we can, for $20 a month or less, for someone opting in, right? It's not everybody, but whoever opts in, who's starting to think about the home buying process, we can give you all of this support and help, right? And it's a pretty powerful idea that for 2 to 3 lattes, right, you can give somebody essentially a home buying coach and a platform full of tools. And it's not even so much about the $200 for the year, right? Because our annual rate is $200. The $200. It's actually about because consumers didn't trust that we were free. They were like, what's the catch, right? So we're like, listen, pay us $20 a month. We'll give you all of that money back at the end, because we can make more than enough money upon transaction. And that's what's been so crazy to me, is actually how much money, we think there's about 1.5 million, every year, 1.5 million Gen Z and millennial home buyers who are stuck, meaning that they could own, but they're either in two camps. One, they don't think they can own, but if you had a reasonable conversation and did some analysis and shared some of these strategies, they could. And then the other just feel overwhelmed, believe they can own, but feel overwhelmed and intimidated. I mean, we've literally had people who had lenders and agents for 2 years, and then within 2 months they bought. And the reason is just because of what we just talked about, this feeling of, lenders and agents aren't always like optimized to be that support system. And it was crazy. I mean, we kept the lender, replaced the agent in this case, right? But like, that's what it took. Like it took someone kind of knowing that. And so, I think where we can build something, there's more than enough money to pay for this type of thing. It's just, for us, it's building this orchestration layer, then figuring out a good distribution model. I'll tell you, trying to build a consumer product, right? You can't just you'd have to throw money against the wall. So this B2B2C strategy is really great for us. In fact, that's why we love Prosperity Now, because my hope is, I don't care if it's, I shouldn't say this. It could be free because we would get these qualified leads and we can help them. But I think it's always worth to pay a little bit of something, because when you do that, everyone takes it more seriously and it gets activated more. But we can, I'm hoping that there's more organizations. Like I said, we're bringing on our first school district, bringing on our first police force, bringing on our first, it's awesome, right? To just be able to go to this, what I think, missing middle and say, we're here, we're a high perceived value but low cost benefit for any employer. So that's kind of the model we're going to be working with from here on.
Yeah, and I think there is a legal and regulatory strategy here that can be pretty strong. What I mean by that is your organizations and working with your first-time home buyers, working with Nestment, are doing work. So when you get paid for a lead, when you get paid for a referral, you'll run into these regulatory questions all the time from real estate agents and, well, mostly mortgage companies and real estate agents as well. But and I think you have to be pretty intellectually honest and say, look, no, we're doing the application for you effectively. It might not be the literal paperwork of the 1003, but we're doing this work. We're doing a lot of data collection, of data verification, of identity verification, all these different things. We can get paid for that. Nestment can get paid for that. So I think that's a really good point. I think when you combine these tools with shared equity as well, you can actually see pension funds, you can see associations. I believe you'll even see municipalities taking an equity position in their constituents, in their employees, in the people that they want to serve. So what do I mean by that? When one of the first movers in this space was Landed, and they were focused on school teachers and public servants in the Bay Area. I don't know if you remember Landed, but
of course.
And they did an equity share down payment to make it possible for you to buy in the school district where you taught or something like that. So you could actually imagine, as we grow this portion of the Venn diagram, that pension funds may actually take a 10% ownership in the homes of the firefighters, teachers, and others that they want to serve. They can also, for less, partner, give out these tools. They can do both. They can do one or the other.
Well, and that would be the ideal, right? Is that you've got the tools to help you set up, but it's connected then. So for, say, Charlotte Mecklenburg School District, it's Charlotte-based,
That's right. Exactly. I want to make sure that we answer any questions that you have as well. So just be aware, we're going to pause for that in a moment, answer any questions, and then get Niles to the airport. But one of the things you mentioned was employers. And I brought up teachers and public servants because that tends to be where a lot of our programs and subsidies and other types of grants get focused, particularly from the mortgage industry, but I think that's true for a lot of different first-time homebuyer programs. But you're also mentioning on stage that the MLS, you told me, I think we can talk about the WNBA. I mean, we're talking about everybody now so when we say like the starter home is dead, it's not just teachers, nurses, firefighters, it's professional athletes can't afford to buy in the market that they play in unless they're one of these higher profile. So talk a little bit about the employer program, and if you think we're going to see a shift to employers. Employers are already responsible for our healthcare and our retirement. Are we going to also see employers, or are you already seeing that it's going to become first-time home buyers go through their employer for this type of thing as well?
Yeah, no, I think you are. I mean, so yeah, it's interesting because we started just working, it was pretty organic, but you had a couple San Jose earthquake players who couldn't afford San Jose, right? And then next thing you know, the Major League Soccer, not listing services, but Major League Soccer and United Soccer League, et cetera, said, hey, can we pilot a program? And it turned out everyone really wanted to know more about how to get through this pathway and felt very similar, like in these situations and around first-time home buying. So I do think that's a huge trend. I think, it's going to be a recruiting tool. It's going to be a retention tool, right? And so at the very least, what we're trying to create at Nestment is the lowest barrier possible. So like if you can't shell out $20 a month for your employee who's opted in, who really wants to do this program, then look at your benefits, right? Because 401k matching is high cost, high value, right? That's a very important thing, but it's very high cost for employers. Now, I think you'll start to see things trend up. There will be these more basic ones that are, low cost, high value. Then you'll start to see higher cost, high value, like so setting up an actual down payment assistance program. We've talked and worked with folks like Oro Impact or like other folks to say like, hey, how can we look at this and set that, set that program up and things like that. So yeah, you have, I think the employer is definitely a big part of this. Even organizations, associations offering this, because I think everyone wants to have a hand in helping. We know if I just look at employers, like the number one stress factor outside of your job for folks who are renting is the home buying process, right? And so we know that it's a key part. So we're excited to kind of grow that. Whether that means school teachers to first responders to tech workers, right? Mm-hmm. So it's that whole gamut.
Thank you so much for joining us on the conversation about what's next for first-time home buyers, and we'll stick around for some questions.
Yeah,
thank you, Niles.
And also, Niles at Nestment, please reach out. We are always looking for great partnerships. We have a ton of free programs. We have free tools. We also have lightly paid, as I say, because I think it actually generates better results for people when people are investing in themselves, or there's an organization they care about that's investing in them, and they're giving a gift. That's the cool thing with this new Nestment Key. I think we're going to be in wedding registries now too. With a couple
Excellent.
Of registries.
Right on.
All right, you guys. Thank you so much.
Thanks
I appreciate it.
And that does it for this episode of Housing Insiders. Thank you again for joining, listening, sharing this special episode. We'd love to hear from you. If you want to sponsor another episode of Housing Insiders, please reach out to us at podcast@thehousinginsiders.com. Review and share this episode, all of our episodes, so that we can put more of these conversations in your feed. Thank you, as always, to Keenan Chen for the music. We'll talk to you again next week.